Welcome to another stock review. This one is the number 2 largest company in the world by market capitalization size. It's Microsoft. I'm going to take a very serious position in this show. Back to back, did Apple last week, Microsoft here. Going to be cool to compare the two results. Also, bonus extra look at Intel near the end. And here's Weeble. Thank you to my Patreon subscribers for funding the Valuation Fund. It uses 100% of the subscription money to conduct the trades on this show. And for you Patreon subscribers, you get to vote on which stock, which company to review each week, every other week. And a thank you to those of you who signed up for Weeble using my link below. You get free stocks, I get free stocks. This time around, I happen to get an Oracle stock. Holy cow, that's worth just about $90, plus it appreciated a bit since I got it. Lucky me. As usual, I'm going to make sure 50% of all the funds that go into the Valuation Fund go into index funds, 40% into the stock market ETF for the US, 10% into the international. Last week, I made a minor math error, which resulted in me buying a little too many of the US stocks. I'm going to buy a little bit less this time around. So we start our journey looking at Microsoft at Finbox. Microsoft is an information technology software company. You've probably heard of it. I think it's kind of cool that Patreon voted for a Microsoft to be reviewed pretty much right after Apple, because that means we're knocking out number 1 on the market cap and number 2 on the market cap. And I don't believe it's too outlandish a prediction to guess that Microsoft will be number 1 in a bit. If you watched the Apple review, I ended up being pretty negative on Apple. I think it's a bit overvalued right now. We'll see about Microsoft. But Microsoft is right on Apple's heels for the largest company in the world. Most of you know Microsoft as the company that produces Windows, the operating system that most people run on their PCs. Most people have also used a bunch of their Microsoft Office, but did you know that they also do Microsoft Teams? Microsoft Teams is something that a lot of companies use in order to collaborate. It's something that picked up a lot of steam during COVID shutdowns. There's Skype, their Outlook, their LinkedIn. They run Azure, a very competitive cloud platform. They actually have a Microsoft Games division as well. The Game Pass is essentially very similar to a Netflix subscription. You pay an amount each month, it's $15, and then you have access to a lot of games, similar to how on Netflix you have access to a lot of movies. With 18 million subscribers, that's $3.2 billion for a year. Microsoft, as you may or may not know, has been quite a successful company. Sure, the 1-year graph looks pretty nice. It's had a really good 1-year run. But when you zoom it out into 5 years, wow, that is a nice graph. Up 463% over 5 years. We zoom out to 10 years. Well, as long as you were a buy and hold investor over the last 10 years, there would be no time where it would have been a mistake to buy this Microsoft stock. This is a monster of a consistent company. Let's just jump right into the financials. The particular video I have this time around is very fact-based, very numbers-based. The revenue has been an incredible grower, actually speeding up distinctly over these last 4 years. Reason? Because they found another place to expand in, cloud. Their gross profit margin also keeps going up. Reason for that? Because it turns out that operating a cloud service is very profitable on top of being a software company. There's gross profit. That's gross. The cost of goods is not very high in a software company. But of course, net income is where you look for the money, the actual profit. And that's a good profit. Casual $61 billion in the last year. Note that Microsoft has Q2 be the end of their fiscal year. So one of their fiscal years just concluded. One very notable thing that Microsoft has been doing, Microsoft spends a lot of money on share buybacks. And while that's theoretically neutral, because The money that they spend on buying back stocks of their own company just means that they don't have the money sitting around. In general, this is a slight positive. This is my opinion. It's an academic's opinion. I'll go a little bit into it as I look at their recent news. Cash flow is always something that I love looking at. And here's their levered cash flow. And here's how much cash they get from running their business. It's just very consistently up. It's no wonder why their price history looks very similar. Just whoosh. Case closed, right? Just buy and hold. I mean, maybe. But as usual, you can always pay too much for a good company. And furthermore, like, is it still growing very fast? So I'm just going to jump right into their annual report and point out things that I found interesting. I believe it is really important to figure out what Microsoft's goal is. And Microsoft's goal is to focus on three things. 1, reinvent productivity and business processes. 2, build the intelligent cloud and intelligent edge platform. 3, create more personal computing. So the productivity and business processes are basically making sure that business can run smoothly and humans can work very productively. That's done using Microsoft Office, that's done using LinkedIn, it's done using Dynamics. Build the intelligent cloud and intelligent edge platform. And I had to learn a bunch about this as well. What is the intelligent cloud and what is the intelligent edge platform? What is the purpose of computing at the edge? Well, IIoT world basically boils it down to minimizes latency, reduces bandwidth, lowers cost, reduces threats, avoids duplication, improves reliability, and maintains compliance. The essential purpose of computing at the edge, as I understand it, is at the point where you gather the data, you calculate the data closer to that, which makes things a lot faster. In short, smart things makes things go faster, get data, hooray. I'm very not much of a technical person, but I think that's a good basic understanding of it. And create more personal computing, that's basically, we want to sell you Surface books, computers, and laptops, and Xboxes. And one of their strategies is Windows, which is a very popular service on all of the computing, can help drive people to gaming services, subscriptions, search advertising, and cloud business, and just generally connecting people to more of the Microsoft stuff. I'll expand on this a bit later. So that's the now. What's more important is the future. Microsoft is trying to transform the workplace to deliver new modern modular business applications. You actually saw that play out very much during the COVID years. Building and running cloud-based services in ways that unleash new experiences and opportunities for businesses and individuals. This is essentially growing out their Azure cloud platform, trying to one-up Amazon Web Services by saying that they offer better stuff, but certainly a lot of research and development goes into running the better stuff, running the smarter cloud, whatever that means. Associated with this is applying AI to drive insights. This is part of the potential benefit of edge computing, where you can just create smarter results fast on the fly. Using Windows, and they've got a new Windows released very soon, Windows 11, they can fuel their cloud business, and they can develop new categories of devices and invent new gaming experiences. And this is really important because it's actually very difficult to describe the future for a tech company. Our future growth depends on our ability to transcend current product category definitions, business models, and sales motions. We have the opportunity to redefine what customers and partners can expect and are working to deliver new solutions that reflect the best of Microsoft. Which is lingo for basically, we don't entirely know what the future holds, but we're going to be what the future is, which is what you hope for a tech company, that they stay hip with it. But Microsoft is really big and their tech is used everywhere, and they appear to be pouring a lot of money into R&D. We can actually just take a quick field trip and look at that. That is a lot of expenses on R&D. That's essentially half of their expenses. They put in $20 billion into research and development. One thing that I believed was really important to highlight from the annual report was the segment results of operations. Not all of their businesses grew at the same level, and that's for the best. So, as they pointed out, there's three directions that they're going for, three areas that they can grow in, and all of these areas grew. Number one, productivity and business processes. That grew 13%, and the operating income grew 15%. The intelligent cloud grew 24% versus 2019. And these are the 2020 numbers. Unfortunately, couldn't get the 2021, but we will look at their quarterly report afterwards and see if this has continued. The intelligent cloud is a very profitable area, and this has grown income 2020 versus 2019 by 32%. So if you're rooting for Microsoft, you're hoping that their cloud business does their best because in growing, because they make a lot of money when this grows. And then more personal computing, 6% growth, which somehow equated to 24% operating income growth. That's very impressive. And looking at their quarterly report, indeed, the intelligent cloud has been highlighted as a segment that has grown a lot quarterly on a year-to-year basis. In quarter one, basically about 12 months ago, they grew 21% year over year. Quarter two, 24% year over year, 23% year over year for quarter three, 29% year over year for quarter four. So this quarterly report also shows you how the previous three quarterly reports for the forward year 2021 worked out. And this particular quarter was the most impressive one. Revenue growing 30% compared to last year. Profit up essentially 39%. Well, operating income, which is not quite profit, but they made a lot more money, both on the revenue side as well as on the income side. It's very promising to see that of the Azure and the service products, Azure grew 45% over 2020's quarter four, and 2020's quarter four grew 50% over 2019. It's a fast growing area, and it makes a lot of money. So, new things coming. Windows 11 available October 5th. That's very soon. It's free, which is a new strategy that Microsoft first started with Windows 10. It's a modern, fresh, clean, and beautiful design. It's set up for the modern world, but it's more connected with the ability to use a bunch of Microsoft's tools. Basically, Windows 11 comes out. Perhaps every segment of Microsoft does a bit better. September 16th, just a few weeks ago, Microsoft approved a gigantic $60 billion share repurchase program. Stock repurchases basically are the company using their money in order to buy back their shares from current holders of the company. This is really good for short term. It means that investors know that there is someone out there with $60 billion which wants to buy back shares. So there's this force that's just buying shares and driving the price up a bit. Over the long term, as an academic, things tend to trend towards their line, but it's very reassuring to investors to know that there is someone out there who is looking to buy lots of shares. When these shares are bought, there are less shares out there in the company, which means that every investor of Microsoft owns a little bit more. Companies do this as a way to return value to shareholders outside of a dividend, which was also increased. And whenever they do this, earnings per share goes up because there's less shares, so the earnings gets distributed to all the shareholders a bit better. Now, it's worth mentioning that I didn't actually think very much of this debut, which only showed up September 22nd. There's a Surface Pro 8 with a bigger screen. There's an upgraded Surface Pro X and a Surface Go 3. And I looked at this stuff and I was just like, I wonder why I would get this and not a laptop. So the Surface Pro 8 coming in at $1,099. You've got the cheaper Surface Go 3 running for $399, but running the Intel Core i3, 4 or 8 gigabytes of RAM, 64 gigabytes or 128 gigabytes of storage. And you've got the middle, the Surface Pro X for $899. Reading all this stuff, I personally was not that impressed, and I was thinking I should just get a laptop. But perhaps for people who like tablets and laptop hybrids. So obviously, this company has gone a long way to become number two market cap. It's a great company. It's making essential stuff that keeps businesses working. It runs the operating system that powers a lot of people's computers. It's a great business. It makes a lot of money. It seems to make a lot more money every year. The only question is it at a good value? So we take a look at the 5-year EBITDA exit discounted cash flow analysis. I've already done a bunch to it. First of all, I entered a beta of 0.9 for Microsoft. It seems to move a little bit less than the general stock market, perhaps because it's considered such a safe stock nowadays, because it's so large and so ingrained in the United States economy. Generally, this stock appears to be less volatile than the overall stock market, which means you expect less of a return from Microsoft than the overall stock market. So I'm using a discount rate of 6.59%. I would be satisfied by putting my money into Microsoft and just getting a 6.6% return, essentially, is what I'm saying here. The assumptions I'm using, these come mainly from the analyst numbers because what do I know? But in general, these revenue growth numbers appear to follow the current growth path. Over the last 4 years, the revenue growth was 14.3, 14, 13.6, and then a big 17.5. But that was the year immediately following the COVID crisis, where a bunch more networks and Teams usage was done. Will this continue? Well, it appears that analysts are a little bit more hesitant to say that it'll continue, but it is possible that this is actually going to go up. You look at the analyst numbers and you consider the previous years and you consider the trends and you think, are the analysts under or overestimating this? One cool thing on Finbox is you can see actually that the analyst estimates have continued to go up over time, which means that Microsoft in general has exceeded expectations. Me personally, I see the revenue growth of 17.5% last year, and I think 14.3% this year. I think that that's a conservative estimate, especially with the release of a new Windows operating system, which could connect Microsoft into a bunch of stuff. But hey, I feel like, we'll just use the analyst numbers. It's a safe conservative estimate. The analysts have numbers for these 3 years. Just in general, you want the revenue growth to go down over time because, well, it's a huge company. Will revenue continue to stay at this amount or will it go down eventually? This depends a lot on what we looked at earlier. Microsoft admitted it themselves. The future of technology is uncertain. So there's a good amount of uncertainty over this future revenue. Will they come out with something amazing or will they continue to make incremental improvements? Who knows? It's fair to just make a conservative 14%, 13%, 12%, and then there's not really much analysts over here. So I just continue to trend 11%, 10% revenue growth. It's a huge company. It's very hard to continue to grow at these rates. The earnings before interest, taxes, depreciation, and amortization are trending upwards. That's mostly because Microsoft is an increasingly profitable company with the main source of growth coming from cloud, which is a very profitable segment. So EBITDA is trending up, and I'm just capping it at 50% because I actually don't entirely know if it's going to go up or down after this 3 years. And then the final big number to consider is what should be the multiple on EBITDA exit? I decided to use 18x. It's currently at 27.2x. 18x takes it back a few years to 2019's. However, if Microsoft continues to put up earnings growth of this monstrous ability, I do believe that this is a conservative estimate. Also worth considering is that we still are in record low interest rate levels, which is helping to elevate the amount of EV to EBITDA. So as eventually when we raise the rates, the EV to EBITDA as well as the PE ratio will decline. In 5 years, I think a fair PE ratio for Microsoft would be somewhere in the 25 to 30x area. So using these assumptions, it looks like Microsoft is undervalued by 7.5%. I came up with a fair value of $320.85, whereas the value of the stock when I looked at it, September 24th, was $299.35. Worth mentioning that a lot of it does have to do with the terminal EBITDA multiple used. If you're using 15x, then it's actually overvalued. And if you think that due to continued good growth, and perhaps the growth will be even better than this, perhaps the EBITDA multiple will be 21x. I mean, that's just about where it is right now. So if you expect it to stay the same, in fact, it's still quite a bit lower than what it is right now. I definitely expect this EBITDA multiple to go down, but it's a difference between going down to 15, 18, or 21. But using the high side assumptions, you could see there's potentially even upside of 25%. And as Microsoft continues to report earnings, it'll be clearer and clearer if this growth is under or overestimating Microsoft. But worth mentioning that if Microsoft is announcing a stock buyback program just a few weeks ago, perhaps hopefully they believe that their own stock is undervalued and they'll buy it because of that reason, instead of just buying back their stock because it elevates prices. We do a sanity check for this by looking at the cool graphics offered by Fast Graphs. I've actually entered these growth assumptions and even gone out another 2 years. So if I believe that ultimately Microsoft ends up with a fair price to earnings ratio of around 30, you can see that this graph, it's currently hanging around 36. And I'm basically suggesting that their price to earnings ratio slowly falls from 36 down to around 30. And if we click this, you can see that this is saying June 30th of 2027, Microsoft stock would be worth $450. It would have gained $150 as the price right now is about $300. They would have given away $16.42 worth of dividends, which provides a total annual return of 8%. Just a nice humble estimate, and that's good. It double checks my sanity that I was willing to accept the 6.59% rate of return, and I thought there was some upside to it. I also take a look at what the analysts think. The analysts have 23 out of 23 buy ratings, and they believe that the stock of Microsoft is worth $334.55 next year. So I discount their price target back to today, which is dividing their estimate by 1.06%, because that's my discount rate. So their price target was in a year, which means if they predicted what Microsoft stock should be worth today, it would be $313.88, which is a little bit under my fair value. But they still think it's undervalued by 4.85%. You definitely want to buy as a value investor when it is under the fair value. And this is under the fair value, but it's not under by a lot. You want to buy when it's under your fair value by a margin of safety. And different investors have different margins of safety. And ideally, you have different margins of safety based off of what company you're looking at. This is the second largest company in the world, and it has a history of basically, if you bought it at any time over the last 10 years, it would be good for you. I actually personally don't own this in my personal portfolio, but after running the numbers and after also considering, these revenue numbers might actually be lower, I could see this being higher. I will state that I am also going to buy Microsoft into my personal portfolio. Now, Microsoft actually represents 6% of the S&P 500, 5.96%, which means that not owning it was like going quite against the general low-cost index fund. And I really don't see a reason why I shouldn't personally own some Microsoft. I can't say that I'm going to buy up to 6% because I think that while it is undervalued, it's not undervalued by that much. My personal portfolio, I try to buy companies that are even more undervalued than this with a bit of a margin of safety. But it's definitely worth holding some of it. I'll probably be underweighted compared to the S&P 500, but at least I'll own some. Now, in terms of the Value Town Fund, it's not often that I get to buy companies that are actually undervalued. This is the 8th company I've reviewed on the Value Town Fund, and this show is, of course, for entertainment reasons, but also to actually invest and hopefully make money. Obviously, in my personal portfolio, I wouldn't put anywhere near the amount that I'm considering putting in, but this is perhaps the best opportunity that I've seen to put money into the Value Town Fund in quite some time. Like, to put it to work. It's been sitting in cash, and I hate that. So I am going to buy 2 shares of Microsoft into the Value Town Fund, which will be about $600. That would represent 20% of the portfolio. So that is a rather large part of the portfolio. So here's the Webull page. Unfortunately, it is long past market close. It's Saturday at 4:37 a.m. that I'm recording this, and I missed reviewing this in time to buy the stocks on Friday. I'm going to state that I'm going to buy 2 shares of Microsoft on Monday, no matter what price it is. Well, not no matter what. If the price goes up a little bit, if the price goes down, if the price stays the same, I'll buy. Even if the price goes up 7%, I'll still buy. We're basically going to buy 2 shares of Microsoft on Monday, and I'll show you the results of which next week. But that's not all. I do find it an unacceptable risk for me to actually hold this Intel bull put spread, which is essentially a bet that Intel does not fall under $50. Now, since I did this trade a month and a half ago, Intel has gone up a little bit, which is great. In fact, this has been a very big winning position of plus $35 out of the $46 that I got initially. So I've gotten $35 out of the $46 by selling the spread. I'm going to sell this vertical, and I'm going to buy Intel shares, as Intel was another company that I looked at that was undervalued. I relooked at Intel, and if doing a 5-year discounted cash flow with an EBITDA exit multiple, I got that Intel's fair value is $54.30, which is very close to the market price. When doing a growth exit, I came up that it was at $53.41, which is a little bit under the market price. I felt like for Intel, this was fair to look at both of those and the analysts and to average them out. The analysts believe that Intel is worth $61.14 next year, $57.09 today. So price target $54.95, 1.71% upside. But it is worth mentioning that that was using the assumptions that in 2022 and 2023 they don't grow, and they grow a little bit in 2024 and 2025. And I'm starting to believe that that's actually a gross misunderstatement of how well Intel will do. Now, I know, and you can look back at the Intel video that I did, AMD is totally destroying them today. But here's the thing, there's a semiconductor shortage, which means, can AMD really take over that much market share? They order chips from Taiwan Semiconductor, and you can only get that many chips. You can only steal so much market share, because even though you have the better product, you can't just sell that much. And a little bit of the inspiration was just by looking up this Microsoft thing. It's like, oh, yeah, they're using the Intel chip for this. I don't know if it's like perhaps a little bit less good than the AMD chip, but if there's not enough chips to go around, maybe you just use Intel's chips. Maybe Intel actually grows over the next 2 years. It's probably not going to be by much, but it would be a surprise, and that would be nice. How will the shortage ever be fixed? I mean, you have to wait until there's more semiconductor fabricators built. And Intel's building them, so is Taiwan Semiconductor. But those aren't going to be up until 2023. But then Intel will be making the money. So this is a really long-term play, but, get in while it's cheap, I guess. Intel's a big player. It's the only United States company. Like, it's really, really hard to imagine this is going to go further down. That's the reason why I bought the bull put spread in the first place. I don't expect this to move much, but I think this is a worthy long-term hold. And I feel like it's going to perform better than my assumptions here. And this fair value is under these assumptions, which are quite grim. This is an example of value investing. Stock is foreseen to be doing poorly in the near term, but in the long term, it's got some real possibilities going for it. And the point is, this is the fair value line, so to say, at a P ratio of 13, which is quite low. Sometimes it's over the line. Sometimes it's under the line. Right now, it's under the line. A value investor likes buying stocks when they're under the historical price to earnings ratio, especially when the price to earnings ratio is as low as 13. The company is still making money, okay? So given that the Intel assumptions are that bad, if I believe that Intel will perform better than that, then it's a buy. I believe, and we're in it for the long haul. So let's buy 6 shares of Intel. 6 shares of Intel at the $54 price point will be worth $324, which is just about 10%. So 10% of the portfolio will be Intel, 20% of the portfolio roughly will be Microsoft. And you have your 15% China, substitute Alibaba, and you just sigh at it when you look at the profit and loss, but you're a little bit happy because you actually don't have Alibaba, and Alibaba has gone down even further. At some point or another, I will switch this over to Alibaba stock. And just because, we're buying the stock doesn't mean I have to hold it forever. As well, I am anticipating that more money gets deposited in, at which point I will not necessarily rebalance it to continue holding 10% Intel and 20% Microsoft for now. I just think that it's worth an entry of 10% into Intel and 20% into Microsoft. And furthermore, in my own personal portfolio, fair disclosure, I will also be buying Microsoft. And notably, I will not be buying Intel in my personal portfolio, though I think that it is a decent value play as well. So that's some big plays. I finally turned my 30% cash position into actual stocks in the companies that will hopefully make money for me. And thank you again to all the Patreon subscribers, which have led to this glorious moment of buying an incredible amount of Microsoft and Intel shares. This is where I pick my value stand and I plant the flag. There are better stocks out there, but certainly I'm not going to miss out on the chance to put a bunch of the money into Microsoft and Intel.